Welcome to Galaxy Brains.
An infinite amount of cash.
I'm your host, Alex Thorn.
The U.S. banking system is sound and resilient.
Bitcoin made a new all-time high.
If you're not long, you're short.
Satoshi's going to come on there, laugh hysterically, go quiet, all Bitcoin's going to be erased.
Bitcoin's the best crypto out there.
Bitcoin is going to zero.
Welcome back to Galaxy Brains. As always, I'm your host, Alex Thorn, head of firm-wide research at Galaxy. Bitcoin not zero. We have a great episode for you this week. Omid Malekan, professor at Columbia Business School. He joins us. He's a repeat guest, and we talk a lot about the banks and stablecoins. What will be the impact of stablecoins on bank deposits? We assess the viability and reasonableness of the bank's negotiating position over stablecoin rewards in the Clarity Act negotiations. Omid, very critical of their position. I think it's a really quite fascinating discussion, a nice long discussion with him. And again, this is a very intelligent finance professor who has worked in the banks, is deep into crypto, and I think he's got a very deeply informed and intelligent viewpoint on the state of banks, deposits, stablecoins. We didn't even get into some other good stuff with Omid, but we'll have him back to talk about L1s, enterprise blockchains, and tokenized securities and things as well. Great guest, and I know you'll enjoy that interview. We'll also talk with our good friend Beimnet, Abebe from Galaxy Trading, as always. We'll get an update from Beimnet on the current state of his Bitcoin thesis. Obviously, being bearish at 110 is a lot more risk reward when it goes to 60 than being, still bearish at 66. I think Beimnet described his current view as cautious. So we're, nearing a good value area. We also talk with Bim about macro and geopolitics and what might happen to markets if the U.S. strikes Iran, which it looks like it might be preparing to do. Before we get into all that, I need to remind you to please refer to the link to the disclaimer in the podcast notes. Note that none of the information in this podcast constitutes investment advice or an offer, recommendation, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. Phineas, my friend, it's no longer 0 degrees in New York. That's a positive.
It's a positive. It's getting warmer.
It's a positive. Did you watch the Super Bowl? We talked about this already, but
I did
how
watch the
upset
Super Bowl.
are we about the Patriots? Are we supposed to be upset?
No, we were early. We weren't supposed to be there, so I think we're feeling good.
But did you see the Coinbase ad that they ran with everybody?
Yes.
And you see the backlash about that ad?
I did.
People were like, even I actually was like, oh, what is this? Really effective in that way. Got everyone to look and sing and possibly even sing along and actually brought joy to the world until some normies saw that it was Coinbase. And there's a famous photo going around that was from a video of people being like, no, and like holding up, flipping the bird.
Because
like,
it's maybe the catchiest song in the history, certainly in our lifetime.
Yeah, they kind of tricked people into singing it. And then I guess, crypto's reputation at the moment being what it is.
At the moment.
Some people were not.
There was a few sort of crypto and crypto adjacent ads, not as heavy as I remember maybe last year. A lot of AI represented this year. Which
I think Coinbase, they did a good job. People saw their name in that sense, but they could have done. They had these other great ads about upgrading the system last year. How it's hard to buy a home. One ad where they had a visual representation of the amount of dollars that have been printed that were much more fundamental to the Bitcoin use case. That I really would have loved to see them use their megaphone for that with such a big audience. But if you remember, they had that ad in 22 that was the QR code bouncing on the screen like the DVD thing. And it was like, they have this idea that for the mass market, I guess, they're not supposed to get too intellectual. They got to make it fun and silly.
And I remember that ad being quite effective. Like they've had some really catchy, interesting ads.
Yeah.
A couple different years.
That's right. It was effective too.
It was effective. I mean, people didn't love that it was crypto, but it was a decent ad.
Well, I mean,
I thought the ads generally were horrible this year. Not interesting.
Yeah,
a lot of like flops.
There was that one with like Ben Stiller and stuff. And he's in the band, and like I love Stiller, but that one just kind of sucked. Like
It was the John C. Reilly one where he's like trying to park.
The
it was
best
just like
ad. I gotta say, straight up, is Jesus is for everyone. You know that campaign to like spread
remember.
Christianity.
Yeah.
They had an incredibly based ad that was like one of those. It's like that Founders Fund video or like these mashups that are like really slick edits. Like there was one about Trump after he won the election. It made it seem like he was like John F. Kennedy. All these historical clips and stuff. I don't know if you saw that.
I didn't see it.
Absolutely legendary ad.
Interesting.
That was the same one where I was like, what is this ad for? And I love what, they're giving you, it's cool music and there's like these slick edits of like historical statements and you're like, this is sick. And then it was like, no way, that was for Jesus. I loved that. I thought it was so good for them. You know,
some good creatives. Yeah.
Well, we had this long convo coming up with Omid. What do you think about that? Because
Omid is brilliant. He's an academic as well as somebody who's plugged into sort of like the street at the same time, which I think is kind of rare. We've had him on. I think this is our third time having him on. We're a show I think that appeals to somebody who's well informed in crypto. Because he teaches young people, he does such a good job of synthesizing these ideas in a way that's understandable.
That's right.
And I really appreciate that. And so I just enjoy listening to it.
I did too. It's a really good one, and I think you'll enjoy it. But let's hear from Beimnet first, and let's hop right into it. Let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome to Galaxy Brains.
Thanks for having me.
Well, we're still down here in the 60s, for Bitcoin. I think, let's start with Bitcoin because I know you've been getting asked, and I've been seeing it in my mentions, and you were very prominent, and we ran that great clip show of you. I mean, if you've been watching the show, you're not surprised. You recall that Beimnet was bearish when I was even challenging our audience to prove him wrong. We were all too poor to do that, apparently, and Bitcoin kept going down. But people are asking now, at these levels, like, what is your Bitcoin thesis now? Like, I mean, we ostensibly wicked to basically level. Your level.
Yeah.
I mean, that was the 200 week is at what, 59K? We hit 60. But, where are you now?
I'm very cautious still. I think in terms of like safe buy area, it's still kind of like the 200 week moving average at that 59K level.
That still feels like value.
That feels like value from like a tactical basis. Like I'm fairly confident next time down there you'll bounce again. And normally in bear markets you do get 20% bounces
and a couple. But multiple tests.
Multiple tests as well.
Yeah.
And normally in Bitcoin cycles, you do eventually end up breaking below the 200-week moving
average. But not
average.
for super long historically, but that's right.
Yeah. And so
I saw that in 2018. You saw it in 2022.
Yeah.
Both times.
There's been a ton of carnage in the crypto market between Octenth, DATS, the recent correction we've had. There's a lot of carnage, and it takes time for that to kind of make its way through the market.
Yeah.
And so my stance is cautious. And I think, wherever the Bitcoin bottom is, you'll have multiple opportunities at it within call it 5,000 points.
Mm-hmm.
And so I think investors can afford to be patient. This is not a market where you need to FOMO in after a 10% bounce. There's nothing that's changed from the catalyst perspective. I don't think there's anything that's going to take Bitcoin to 90, 100K anytime soon. And so I think right now it's probably a range trade with the potential that, as we've mentioned in the last two episodes, if you do get a correction in broader equity markets, that I think is probably what could take Bitcoin below the 200-week moving average. And I think a break below the 200-week moving average, probably gets sold into.
Yeah. So it accelerates a bit.
Yeah. But my thought process is if you're a long-term investor, you're the difference between 50 and 60K, I don't think really should make that much of a difference. And I think in terms of the best long-run approaches to an asset class that you're fundamentally bullish on is just a dollar cost average. But I don't quite think the bottom is in yet.
Yeah.
I do think that the 200-week moving average will serve as good short-term support. But ultimately, when you think about Bitcoin in the 4-year cycles, you do see 70% corrections. Mm-hmm. And a 70% correction from the highs gets you to about 37,500. Mm-hmm. And so that is the bare bottom that I think we can get to, maybe. Mm-hmm. But that is contingent upon equities having a meaningful correction.
We have a major down year in equities this year, then sure.
You could, sure. But if you're constructive generally, I think you'll have another opportunity at 60K. I think if you're trying to deploy over the next year, if you start your DCA program now, it's not crazy.
Right.
But I do think that normally it just takes time for the market to heal.
Yeah.
and you'll have plenty of opportunities if you're looking to stack sats, in the next 6 months.
Yeah, I think that makes a lot of sense. What I'm hearing as a summary is you're not really bearish, meaning that you're not you at this level.
It
the
would
risk
be,
reward.
it'd be hard to go short.
That's right, because
It'd be very hard.
That trade was
Already
better at
played
100.
out. Yes, correct.
Yeah, so it's not, but it could go lower, and
Yeah.
you're saying, historically, even without necessarily a macro rollover, I think both kind of did have a little bit of one in those prior.
They did. Like 2022 with
Yeah.
the rate hikes and.
Yeah,
But long story short, it normally takes like a full year,
it could take a
right?
long
So
time,
October
you're-
to October is kind of that time series.
I see.
Right?
So you're likely, so it could go lower. It's not like, and the one thing I would say about, although I don't think we've ever really seen a bottom hit in a bear that just hit once.
Correct.
Never. So
Yeah.
But the carnage, the capitulation and fear of February 5th, did, like, if later we looked back on it and it was the literal bottom, we'd be like, we were there during it. It was pretty
Yeah.
panicky. Like that is the sort of usually the nature of the scariest wick.
Yeah.
Doesn't mean that, but again, like it's not a strong enough V-shaped recovery here either. Not like April of last year where we
Correct.
really roared back pretty fast.
Yeah, and generally, I just think you'll be rewarded for having patience in this market, and like the setups will be clear. I also think that like there was a lot of liquidations, etc. But just here at Galaxy, like every client met their margin call.
Yeah.
Right, and it didn't feel like everyone's throwing in the towel on crypto, and that's normally how markets bottom, where like everyone gives up hope.
Yeah.
And it doesn't feel like that. I think there's just a lot of optimism, and I think that optimism is totally fair because the from the traditional finance world, there's still a huge push to adopt crypto rails. Stablecoins are still prominent. There's still legislation
Parity
being
Act could still
proposed.
happen, right.
And so the adoption narrative of crypto hasn't really slowed down. I would say it might even, in fact, be accelerating.
Right.
But that doesn't mean that the value proposition of crypto rails has to be tied to price.
Right.
Right. And so I don't think folks have quite thrown in the towel on price.
And you kind of, in your mind, you're saying for you to confidently feel like we have bottomed, you wanted to see more capitulation on price and narrative than you did see, even though there was a lot of carnage that February 5th.
But again, like we're looking at gold trading around 5,000. You're looking at S&P at 6,900. Like
isn't there a meme coin called that? I don't know. That's not aggressive.
Something. I mean, Dow around 50K.
Yeah.
And so like we haven't really seen like a meaningful tape yet where equities are in proper like trouble.
Right.
And so I'm just curious as to see
if
like
we see that.
if
it's
we
very
see
reasonable
that
to see a lot of other stuff roll. Yeah. Okay. Before we break, let's talk about equities and macro a little bit here.
Yeah.
What are the current drivers, risks? I mean, we talked a little bit about the widespread
AI contagion.
realization of AI, even though it's been, prophesized for a long time, that has gripped some of the market. What else is there out there that's driving market, sentiment?
I think there's generally like a lot of rotation into like industrials and energy and like real world.
That's what they said. Instead of software, now it's hardware, right? It's
hardware,
like,
yeah. And so you've seen like industrials trade really well. You've also seen like a big move in non-U.S. Equities, right? Like the KOSPI has had a huge run. I think like this is the biggest divergence between S&P and MSCI all
this
world
is
in
the anti-dollar trade, right? The dollar
de-dollarization.
the de-dollarization trade, as they say, right?
And so like
also partially driving gold, probably.
Yeah, absolutely. And so there's been a big push to invest outside of the U.S. and you've seen that in the performance of like every other like major equity market relative to the U.S. and especially relative to like Mag 7.
Yeah.
And so I think those are themes that probably continue, would be my guess. But again, like that relative outperformance can happen in a downward moving tape in general, or an upward moving tape, or a flat tape. Right.
That's a relative trade as opposed to
yeah.
absolute. Yeah.
Yeah. And so those are kind of the big thematics, industrials moving away from the U.S. And generally speaking, like, the trades that are working are like things like memory, stuff that benefits from CapEx spending, not the companies doing the spending, but stuff,
Stuff they buy with the spending.
Correct.
Yeah.
And I don't know if that slows down. And the only way that trade slows down is if the Mag 7 decide to spend less on CapEx.
They're still guiding higher on CapEx.
So these numbers are
the amount of
insane.
Money. And then I wanted to add too, I saw it's been going around. It's not been, I think, specifically acknowledged by the U.S. government, but a lot of open source intel analysts are pointing out that the U.S. is currently moving enormous amounts of military hardware into the Middle Eastern theater. If the U.S. strikes Iran, like, what would you expect the market impact to be?
I mean, I think it's like generally with these types of things, it's like a quick risk-off move that gets bought.
Yeah.
So I'm thinking like maybe S&P down like 1.5% to 2.5%. That probably gets bought. VIX probably spikes to like high 20s would be my guess. But it's really tough to know like, okay, you do these tactical strikes, but what's the follow-on? What's the contagion risk?
It's really interesting because he's been the president who controls the military has been moving these assets, but they also seemed to announce that they reached the framework of an agreement in Geneva. Now that can make sense, by the way. Like, right, whether or not that holds, and I don't think we have details on it.
I don't think they reached an agreement. I think essentially the Iranians were like, we'll come back to you in 2 weeks with like
after Ramadan.
Yeah. Well, Ramadan, I think it was a month.
Yeah. So
But point being is, there are still negotiations, and so there is hope for
de-escalation.
a de-escalation. But at the same time, like the magnitude of the military movement is one that is
it's substantial.
It's substantial.
Now that can obviously even in the like that can be posturing during negotiations. In fact, it is posturing.
I think it went past the point of posturing.
Yeah, I kind of agree. It looks like something is probably imminent here. And
there was one U.S. official today that was quoted by I think Sky News or somebody like that. That said, we're not sending people to all these bases to just sit around.
Yeah, that's pretty
and
ominous.
All the equipment. And so, and the other thing is, I've heard some theories that, striking during Ramadan or right before
around it,
might be a little destabilizing in
for
the
broader
context
Middle East.
of like our Middle East allies.
That's right.
But at the same time, the game theory in me says that if you're playing to win, why would you give your opponent a month to prepare?
Yeah.
And so I think
it seems like if the decision is made to make a strike, they wouldn't consider Rama, I wouldn't think.
If you're playing to win.
Yeah, the other thing that was interesting, I talked to a friend of mine who's an Iranian expat, and he was talking to his relatives that are still in Iran, to the extent those communications have been possible, and they are periodically. The internet has been degraded at levels never seen before. They actually straight up cut it off for a week or two, but also they can't do that for too long. That messes up the regime's own internet. But also they pointed this out, and you can see this if you go to the Iran Monitor. I think it's iranmonitor.com. They track this. They're tracking the most casualties by regime forces against Iranians more than all other prior uprisings combined since the 1979 revolution. And this had been one of Trump's sort of red lines that he had promulgated was like, stop killing the protesters. Terrible stories coming out from there. So you could imagine the president wanting to back up his prior statement and striking, even in the case of like a token strike. I'd hate to say that, dropping.
No, I mean, I think they're going for the jugular here, right? Like full regime change, like.
Surely it must be on the table. I just, Iran is
geostrategically
like very well ensconced.
It is, but it's like, if you want to take out their nuclear capabilities and put in a regime
we already do that? Didn't we already? Maybe. I have seen that show Tehran on Apple TV, which is quite good. And
maybe I'll check it out.
It's a very good show. And but yeah,
they sponsored.
Thank you, Apple, for the sponsor. For full clarity, I am not sponsored by Apple or anyone else except for Galaxy. But they show there's a part with the underground nuclear facilities, and the way they describe it in the show is like they're very, very far underground. So,
No, I mean the chatter is like there's the potential of using tactical nukes
yeah,
instead of the bunker busters because the tactical nukes.
could actually reach it or something.
Yeah,
Well, interesting to hear your take on the last thing on that. Actually, the oil's not a big concern at this point. So much Iranian
it's up
oil.
5% already today.
So is that like speculate? I mean, but how much?
It could be
how much
speculative.
supply is Iran actually getting out in the market? Not a lot, right? Like, with sanctions and stuff.
I mean, I think there's still buyers of Iranian oil, but the questions are really around oil are kind of around like Strait of Hormuz.
Right.
Like, are they going
That's
to be
fair.
able to close that off? The answer is probably not.
Yeah, but I mean, like if they close, but even if we're engaged in an actual military conflict with Iran, presumably the strait is not safe for cargo, even if neither side's formally trying to close it. Like, what are you going to do? Like two guys shooting at each other, and you're just like with your like food cart coming by, like, don't mind me, I'm just going to deliver my groceries, right? Like, seems unlikely. That's a fair point. So it's not Iranian supply as much as just disruption to the distribution that you'd be watching for.
Yeah.
Yeah. All right. Well, my friend, this is great. Beimnet Abebe from Galaxy Trading. Thank you so much.
Thanks for having me.
Let's go now to our friend Omid Malekan, professor at Columbia Business School. Omid, welcome back to Galaxy Brains.
Great to be back, Alex.
Is this your third or fourth appearance?
Third, I think.
Third, yeah. The first one was SVB collapse, which I think was my favorite rap that I did in 23.
Well, it was certainly my favorite rap because it was about me.
Yeah.
And I still play it for my students sometimes when I need to perk
I
them
said
up.
the weekly podcast from Galaxy Research, the chancellor's on the brink of backstopping reserves, which was the bailout.
Yeah.
What do they call that bailout? There was the BTFO or
It was the regional BTFP,
Yes.
which is just one letter removed from BTFD, which is probably what you should do with all sorts of assets every time they say that they're going to paper over market problems.
Yeah. They stepped in, and the bank's fragility was, the banking system's fragility was put to test and shown. I think one of the big takeaways that a lot of people had was the speed of deposit flight then. Right. And it was not because of crypto in any way, but because of fintech, because of the apps. You could just go into your SVB thing and instantly send the money out or go to Zelle or whatever.
And social media.
Right.
And it's very relevant today because there has always been a assumption in sort of banking academic circles that deposits are sticky, that people don't move their deposits from banks, even when you could argue they should, or even though when you could go to another similar bank and it pays more interest. But the regional banking runs, which I still believe started with Operation Choke Point 2.0 and the way they suppressed the crypto banks. But nevertheless, to your point, clearly deposits were a lot less sticky than everybody had assumed. And then the other thing that was revealing to me is that was 2023. So we're literally exactly 15 years after the great financial crisis. And we had two of the largest banks in America, SVB and then also First Republic. There was also Signature fail, which sort of proved that eliminating bank runs and banking crisis to me is an unsolvable problem. And instead of constantly being like, well, it happened again, let's have even tighter regulations and supervision to prevent it, maybe we should move to a less levered banking system.
Interesting. Yeah. And they tried to blame crypto for SVB simply because Circle had deposits there. But of course,
which they didn't get out.
Right.
It'd be one
it
thing
wasn't
if,
them that sucked out the money. Yeah.
Yeah. I always find it kind of a ridiculous argument when there's any attempt to shame people who run from a troubled bank.
Right.
Like depositors don't owe banks risking their life savings. Banks owe depositors soundness and stability.
Right.
And when you achieve that, then no one will ever run. So you won't have a problem.
Yeah. I mean, it's like they think that they're all people who make that argument think they're George Bailey saying like, the money's not here in the bank. It's in, Omid's house and Alex's Ferragamo sneakers.
Right. Which ironically, especially for the large banks, it increasingly is not.
That's right.
The money is at the Fed and the money is in Treasury and agencies.
And we're going to get to this too, because the question of what deposits are actually used for, if anything, is an important part of the bank's argument in the Clarity Act about restricting yield and deposit flight. But a few more too on the regional banking crisis, because that really was an exciting and dramatic time. Bitcoin performed very well around that. I think SVB in particular, I think it went from like 20 to 30K, if I recall, which is a 50% increase at the time. But they did also try to blame crypto broadly, and you mentioned Signature and Silvergate, but it was so disingenuous. Like Silvergate literally wound down; they didn't lose a single dollar,
which is remarkable and almost never happens.
like unheard of.
Banks don't voluntarily
Right.
shut down.
Right.
Banks either collapse or are
Taken over
by the government,
Yeah.
preferably. Yeah.
And they were bullied out of existence.
Yes.
By Operation Choke Point 2.0 stuff. And then Signature was effectively decapitated, right? I mean, Barney Frank, the irony that like one of the named sponsors of the seminal banking reform bill, Dodd-Frank, was a board member at Signature Bank. And he said they were solvent.
And he claimed political motivation, which ultimately we might never know. But I did think it was telling that the FDIC takeover of Signature, which was a New York State bank, so it began with the New York State regulator, was announced in the same press release where the Fed announced the BTFP for every other.
Yeah.
So it's always telling when they say, well, we're going to save all the other banks, but this one has to die,
Right.
which has since led to other kinds of speculation as to whether they sort of needed Signature to fail. But Choke Point did play a part in it, I think, for two reasons. First of all, it's always been understood that industry concentration in banking is a very bad idea because of the fragility of levered or fractional reserve banking. You want a diverse set of depositors. So in that regard, it was not good that the entire crypto industry was in one of two banks. However, why was that the case? That was the case because all the other banks, we now know, were basically ordered by their regulators not to bank crypto. Right. Like I'm sure, well, I know as a fact, because I happened to be working at one at the time, Circle would have preferred to keep billions of dollars of its reserves at the GSIBs, aka too big to fail banks. But they weren't welcome there, and regulatory pressure had something to do with this. And then the other thing is, I still think it's remarkable in early 2023, the major federal banking regulators put out a joint memo explaining how they thought crypto deposits were risky.
Yeah.
And to me, this is one of the most irresponsible things bank regulators in this country have ever done, because there's a general rule. You publicly never, ever talk about deposits being risky, right? There's a reason why in the middle of every banking crisis, 08, 2023, you have all these government officials and regulators say something like, our banking system is safe and sound.
Yeah.
We know they're kind of lying, but we also understand why, because can you imagine if they go to the public and say, well, actually, all the banks might fail.
They would cause it.
They would cause it.
Yeah.
But in this case, I thought it was remarkable. Here you have regulators saying that a certain industry with concentrated deposit in certain banks is dangerous.
Yeah.
And then sure enough, those are the banks that blow up 6 months later.
That's right. And there were politicians beating that drum as well. Sherrod Brown, Elizabeth Warren.
I forgot about that.
On the floor of the Senate.
Yes.
Also, like this, almost the same day. So there was that, I think it was January 3rd, which was auspicious from a Bitcoin standpoint. 2023 was that first joint notice from OCC, FDIC, and the Fed.
Mm-hmm.
And then on January 27th, they had another joint one, and that was the same day they also denied Custodia's master account.
Wow.
Brian Deese, who worked at the White House National Economic Council, the NEC, I believe, published a blog post at the White House the same day, ostensibly about crypto innovation, but was all about how risky it is. The joint statement was basically extending that guidance to capture state banks from January 3rd.
Right.
And then the first time the Senate opened, which I think was like, February 1st or something, like around, because that was like on a Thursday, Sherrod Brown and I think Dick Durbin gave a very long floor speech about how crypto's terrible, attacking Abby Johnson,
Wow.
talking about Silvergate and Signature. And it's hard to think that's not coordinated. Like,
Yeah, either by some of them or all of them.
yeah. I mean, I had fingered this guy, Bharat Ramamurthy, who was I think the head of the NEC.
Who we might think might have been behind
Yeah,
Choke Point.
Yeah, I think, and in fact, it had been confirmed by other reporting and by reporters that he was the one that called Maxine Waters and told her to kill the Pat McHenry Maxine Waters stablecoin bill at the time in like the summer of 22, I think.
Which happened sort of like in the final hours, right? It
looked like they were close.
Yeah.
So anyway, we've come a long way since Chokepoint 2.0. One of the other things that was so damaging to crypto by the collapse of Silvergate and SVB was that Silvergate ran the Silvergate Exchange Network, which was a real-time dollar payment system internal to the bank. So if you were a client and I was a client, I could send you dollars like an internal Zelle or Venmo, even when the bank was closed. And that was how crypto was moving a lot of money around to trade these 24/7, 365 markets outside of bank hours. And Signature had Signet, which was a competitor to Sen. And these were the main two like dollar settlement networks that crypto was using.
Yes.
Both of them killed by the takedown. And for a while there, it wasn't just that you couldn't get a bank account easily, like your own business bank account if your business was crypto. It was also that there was almost no way to like get dollars to and from an exchange in size because we'd all been using those systems.
Which might have forced a lot of the crypto industry to adopt stablecoins even faster than they would have.
That's right.
Which is a fascinating reflection of what I would call sort of the whack-a-mole nature of good technology.
Yeah.
You can't kill it. If it's a good idea and it solves important problems, people will figure out how to use it.
That's right. It's kind of like it's like cigarettes in jail, you know, like whatever the best money is going to emerge to be used as money, right? And you can't always control that or engineer it. It's very emergent. So stablecoins is a great pivot because stablecoins did ultimately emerge, and they certainly have now. No one really quite needs Sen or Signet the way they did then, partly because the safety of the major stablecoins is really widely believed, at least by crypto market participants. So we're all comfortable settling in stables, which also, of course, move on permissionless rails 365, 24/7. It is the successor, but how do you view then that they'd already been adopted, but then we got Genius Act passed into law? Like, how do you view that as a milestone in the stablecoin story, the passage of Genius?
Genius is a remarkable bill because you could argue it is the most transformative piece of financial legislation in the U.S. in decades. It's certainly the biggest since Dodd-Frank, but Dodd-Frank was a restrictive legislation. Right? The point of Dodd-Frank was to curtail what financial institutions could do. Genius drastically expands it, and it also finally makes available something that I would guess most ordinary people, if you actually explain to them the dynamics, and certain respected academics have wanted forever, which is a narrow banking option. This idea that we have to force people to save money or make payments via highly, highly levered financial institutions that are run-prone just strikes me as a bad idea.
Yeah.
I think I would have said that if I was around 50 years ago, 75 years ago, but we now have that much time and history of increasingly catastrophic financial crisis, which always start and end with the fragility of highly levered financial institutions. And look, we work in crypto. We know the dangers of leverage. Almost nothing good ever comes of it.
That's right.
So this idea that you couldn't give savers a safer option, the Fed would refuse to give narrow banks charters and access to their payment infrastructure, but Genius changed all that.
Right, it does. It moves or creates not only a fully collateralized payment option, it is on permissionless open rails as well. So it's actually, you're right, it's revolutionary from a banking and payment standpoint.
Yeah, and going back to what you said earlier about Sen and Signet, I always thought it was funny at the time that the exception in banking was being able to make 24/7 payments to other customers of the same bank.
Same bank.
Like databases don't turn off at night.
Right.
You know? Like they don't get tired.
That's
you
why I
don't
always
need to
laugh.
like oil them overnight. It's just the archaic architecture of banking where it's like, oh, well, even if you're sending money to another customer, we can't process that in real time because it's a weekend.
I always laugh about like when the major securities exchanges like NYSE said that they're going to do build a tokenized securities exchange, and it will allow 24/7 trading. Yeah. And I was like, but couldn't you just leave your normal servers on? Like, I don't, no, I'm not quite sure. I mean, we could get into settlement and stuff and how it is better with token, but like, surely you could just not turn off the server at 3:59 and 59 second. Like, you could just leave it running.
Almost every single benefit that TradFi ascribes to crypto is wrong. Meaning it's not a crypto thing.
Right.
Like you don't need crypto to do even smart contracts. Attaching a line of code to how a transaction happens is not hard. Right. We already have databases. You can have software that results in change entries in databases.
Right.
That's what all of TradFi is, just ledgers and databases.
Right.
It's just a question of the trust assumptions. Like, do you trust who's running the database? Can they turn it on and off at will? Is it open or censorship resistant? And who gets to run it? Which ironically, almost all of these private permission tokenization efforts, they have all the same pitfalls and trust assumptions.
Right.
So they don't achieve anything.
I think that's a great point. We're going to get into this too, because what is the actual value proposition? You have a great book, Re-Architecting Trust, about blockchains and how, and that book's really interesting because it's not primarily about the technology. It involves the technology, but it's really a history of trust and what it means to have a system like, a public permissionless blockchain or DeFi that totally re-architects it. Is that the core innovation, right? It's not sending money fast. I mean, if Sen and Signet showed they could send money fast,
Yes, the core innovation is the changing nature of the trust assumptions. I've actually gotten to the point now where I will no longer call a private network a blockchain.
Yeah.
Because as part of my own learning, I've come to realize that all of the cryptographic features that an actual permissionless system like Bitcoin, Ethereum, Solana, et cetera, has are almost irrelevant if you permission the validator set. Hash functions are useless. The database is not immutable. Public key cryptography as a method of authentication is useless because you could just censor who the users are. So it doesn't matter. The fact that you have a private key is not what gives you true property rights over your Bitcoin. What gives you property rights over your Bitcoin is that you have a private key that nobody could prevent you from signing a transaction and having that transaction be approved. Banks could give us private keys, but then they could also debank us, or you can send them a signed request for a payment and they could just say no. So it's such an interesting time, whether we're talking about stablecoins, tokenization, real world assets, et cetera, where we've now crossed past the point where people in power question the appeal. And the debate now is the how, right? Like, we're not debating whether we're going to have stablecoins. We're debating what kind of stablecoins will they pay interest, how will they be regulated. We're not debating whether we're going to have tokenization, but amazingly enough, we're debating whether the New York Stock Exchange and the DTCC and all the brokers they do business with today, if they deploy a fake blockchain, whether that's tokenization. So progress, but still a long way to go.
Yeah, agreed. Let's talk about stablecoins more. Let's talk about the Genius Act and this current debate that's happening on the Clarity Act. The Genius Act very clearly prohibited issuers of stablecoins that are licensed under the Act from passing on rewards to token holders of their stablecoin. It notably said nothing about third-party intermediaries doing so. And since Genius passed, Coinbase and others have continued to pay rewards or pass on rewards. Whether I'm not an expert in Coinbase's business, but my understanding is some of the rewards they'll pay to a USDC depositor there are derived from some revenue share with Circle, right?
Well, certainly not from them lending it out.
That's right.
Which is an important distinction to make.
Because the rewards otherwise, it is so interesting because to get to your point, if I deposit in a savings account at a traditional bank, let's say they do pay me some yield. Reality is most don't pay much, but let's say they're deriving that from the lending and other financial activities of the bank.
Risk-taking activity, that's
with
right.
my deposit. Whereas a collateralized stablecoin sharing rewards is passing on treasury yield from the underlying collateral, which is fully collateralized. So inherently safer. And this is your point about it being a narrow banking option for payments.
It's safer and it pays more interest. So it's superior
Yes.
for the end user.
That's right.
It's not superior for an intermediary that hopes to get cheap capital to deploy to make money.
We're going to get to that too, because you had a great article today on X about that, about whether this cheap capital deposits at banks, for example, really does create good credit for the economy, or whether they're just doing something else with it or keeping it for themselves. But let's talk about the banks and clarity. So now we have this. The second major legislative effort in crypto is the market structure bill. So we legalized stablecoins and created a framework with Genius for certain types of really high quality, safe stablecoins in the U.S. And then the other big thing the industry wanted was to not be railroaded by a future SEC chair like a Gary Gensler. And so we wanted clarity on which market regulator regulates which type of asset and intermediary under which circumstances. But by the way, a desire that there be a market regulator to do so.
Indeed.
And that role be codified in federal law so that it can't be rolled back easily by some intransigent, chair of a market regulator or a president.
Which, by the way, is the kind of thing that I would say if you're for or against crypto, ultimately you want Congress to create rules that address it, not this political process of the political appointees at regulatory agencies making the decisions.
That's right. And with Lopper Bright to the Supreme Court ruling, I think, again, not a lawyer, although our audience knows I sometimes pretend to be one.
I think you make a very good lawyer.
Thank you. That Supreme Court ruling also restricts independent agencies' ability to use interpretive guidance versus, beyond what they are directly authorized to do in the statute. So I don't think any of us want to wait for Supreme Court cases to play out as a way to protect us from a market regulator who reaches beyond their authority, especially to hurt us. Mm-hmm. So we want this in federal law. Now, all that stuff's great. How to handle DeFi, which types of things are decentralized enough to not be regulated versus, a business like Galaxy, if it's trading digital commodities, should it have a digital commodities license, right? Stuff like that. All makes a lot of sense. And it seemed like we got to a pretty good compromise on almost all of these issues. But at the last minute, Coinbase and mostly the stablecoin issuers, I think they raised that the emerging compromise on this yield question wasn't palatable to them, and it's true it's not palatable to them, right? Because the banks, literally the banks, I don't know, this monolithic group, and it's like the Bank Policy Institute and the ICBA and the American Bankers Association, all decided they were very mad and wanted to effectively retrade the stablecoin rule about yield from Genius in Clarity. And they've been making a few arguments about why, policy arguments. We know that they have their own arguments, right? They really just don't want to give up their control over the payments systems, probably.
And they don't want competition.
Right.
That's what it comes down to.
Right. But the arguments they're making, I think it's two primary arguments, maybe three if we throw in a third one. One is that there will be stablecoins will result in all this deposit flight out of the banking system. Or, in fact, they've even said that out of the banking system, which is hilarious because that's not actually possible. That's not how dollars work. But at least, so then they say as sort of a corollary, the second point, well, maybe not out of the whole system, but out of community banks, which is a hilarious way it's like a backhanded compliment to the community banks. They're saying, look, you're so important, we got to protect you. But by the way, you suck so bad that stablecoins will kill your business if they're allowed to pay even like 1% in yield.
Right.
And then I would say the third argument that they've been making is that it'll generally destabilize the financial system if non-bank payment stablecoin issuers are allowed to pass interest to depositors.
Right.
Let's talk about these arguments. So the deposit flight you've written about, you just wrote again sort of about it. Is this a genuine threat? Because there was this, what are the banks, what is their argument, and is it real?
So the truth is nobody knows exactly how stablecoins are going to impact bank deposits. I actually think at this moment in time, regardless of what happens with this legislation, there's a 50-50 chance that they actually just increase bank deposits. When it comes to private forms of money, which both a stablecoin and a bank account are, it's really, really, really hard to take money out of the system, right? Just in academic monetary terms, there's inside money, which is money that's issued by a private entity, and outside money that's either money issued by the government, like the Fed, or gold and Bitcoin.
Right.
it's really hard to shift the balance of inside money. And we have data points because we went through the same exact debate in the 90s with money market funds. Fast forward to today, $5 trillion in money market fund, more deposits in banks than ever. And when you throw in the fact that for now, and probably for the foreseeable future, most of the stablecoin demand is coming from offshore, from people who are not substituting from dollar bank accounts, but substituting from other currencies or other assets, it's quite possible that bank deposits just go up. But let's steel man this, right? Let's say that there is a future state in which some stablecoin adoption domestically leads to less deposited banks. What does this mean? Because the arguments that all of those trade groups have been making is, one, you just get less credit creation. Two, the credit creation that you do get is more expensive. And three, the more vulnerable parts of our economy, whether it's regional banks or, for example, small businesses that require small business loans, those are the people who stand to lose. Now, this is something that big banks will say, well, we'll be fine. But it's really like the First Bank of Nebraska that I'm worried about, or whoever we get a loan from them.
Yeah.
So let's go through all of this. First of all, we need to acknowledge that banks in the U.S. create a minority of credit. They only account for approximately 20% of loans to the private sector. Right? We're blessed in that we have very sophisticated capital markets, the bond market, and we have large and sophisticated non-bank lenders like insurance companies, private credit, et cetera. And there's a whole argument that actually that's safer because they don't face runs the way that that banks do. Right? So banks create a minority of credit. They would still argue that, yeah, sure, but because we have access to deposits, we provide cheaper credit. So the 20% that we contribute to cheap deposits equates to cheap loans. And if we're forced to pay more to compete with a yield-bearing stablecoin, then we won't be able to make cheap loans anymore, right? But of course, today, there's virtually zero domestic stablecoin adoption, right? And what there is doesn't actually pay yield anyway. So if their math is correct, we should be living in an era of abundant and cheap bank credit. So I actually went and looked at the numbers.
Yeah.
Deposits we know are cheap. The FDIC data shows the average demand deposit in the U.S., which is a checking account or savings account, pays just a little bit more than 1%, which is very low because the Fed funds rate is 3.6%.
Yeah.
Right? Like T-bills pay that. Money market funds pay that. Banks are paying a fraction of that for whatever reason. So they have access to cheap credit. Does that translate to, they have access to cheap deposits. So does that translate? Well, credit card interest rates are on average over 20%.
Right. It's like an all-time high, right?
Near an all-time high. The rate that banks charge for credit cards over the prime rate, which is supposed to take into account the cyclical variables, has been steadily climbing for a decade now. And only banks could issue credit cards. So the same banks that borrow money from Jane and John Doe at 1% will turn around and lend it back to them via a credit card at 20%. And credit cards are the most widely available type of bank issue credit in America, right? Most people can get a credit card even if they can't get a mortgage or a car loan. Right. So it doesn't translate there. If you look at auto loans, same exact phenomenon. Compared to the average over the last 20, 25 years, auto loans are very expensive. They're a little cheaper than they were a couple of years ago. All rates spiked post-COVID. But nevertheless, the last time auto loans were this expensive, banks paid depositors double to triple what they do today.
Wow.
Right? So once again, same thing. And then this is also true for mortgages. Banks don't issue most mortgages, right? They're securitized. But the mortgage market is so massive that banks hold several $1 trillion in mortgage debt on their balance sheet. And there too, right? 30-year mortgage as of this week is 6%. If you go all the way back to before the financial crisis, the last time mortgages cost this much, deposit rates were significantly higher. And there is another way we could look at this, because if cheap deposits don't translate to cheap credit, then they translate to bank profit. right? It's just their cost.
Right.
So we can look at banks' net interest income, a widely reported, easily calculated number. And according to the FDIC and the Fed, as for last year, U.S. banks made something like $750 billion in net interest income. And to put that number in perspective, I believe that's more than the Mag 7 made in net income combined.
Mm-hmm.
So this is a wildly profitable activity,
Right.
which would not be the case if what banks were doing with the cheap deposits that they have exclusive access to was passing it on in terms of cheap credit.
That's right.
And look, good for them, right? I'm all for profit, but it just shows how disingenuous that particular argument is, because it turns out when banks have access to cheap deposits, they just make more money.
Yeah, they're not actually creating all this credit they claim will go away if the deposits aren't cheap right now.
Right. Nor are they passing on the savings
Right.
to consumers. Now, people will push back to this argument and say, well, hold on a second. Banks take risk, and they need to be compensated for that risk. That's why there's a net interest income in the first place. And it's true to the extent that credit underwriting is risky. People default on credit cards and car loans and mortgages. Then you do need to compensate the lender. Otherwise, they just won't bother giving that loan in the first place.
That's right.
But this is sort of a misunderstanding of how banking works today in America, particularly the very large money center banks. They're not underwriting $5,000, $10,000 loans to small businesses.
Right.
What they often are doing is taking the money and they are either parking it in treasuries or agency debt, like mortgage-backed securities, or parking it at the Fed. And combined right now, the largest banks have about, I believe, $5 trillion. So all banks have $5-6 trillion, which is something like a third of the M2 money supply in the U.S. So a substantial portion of the balance sheet of banks on the lending side is going into things where there's zero underwriting. If you buy T-bills, you buy T-bills. And there's very little risk, right? Like if you park your money at the Fed, and for absurd monetary policy reasons I won't get into, the Fed will pay banks 3.6% to take money out of circulation.
That's right.
To not lend that money out.
Right.
Leave it at the Fed, which does nothing as far as like economic growth is concerned.
Right. It's not being invested.
No, but it's profitable, right? Like, so the simplest thing that when you give your money to a bank in a checking account and they pay you zero interest for checking accounts, the simplest thing they could do with that money is just deposit it at the Fed. And the real irony of this calculation is whether it's T-bills or interest on reserve balances at the Fed, where does that money come from? It comes from taxpayers.
That's right.
So banks pay very little interest to taxpayers when they open accounts, but taxpayers pay a significantly higher interest to the banks.
Yeah, very, very bizarre. And so if I summarize the argument that there'll be deposit flight, you've I think I'd say eviscerated across a couple of vectors. One, they're not the biggest source of lending at all. Two, they're not actually doing the cheap lending, really, mostly, that they claim they won't be able to do if they are competed against. And that's the core of it, right? I mean, they aren't. And three, you pointed out that, by the way, if they were doing that, they would already have faced this competition. And by the fact that they're just clipping it as NIM rather than actually giving out the credit or seeing deposit flight, which they haven't, they didn't even see it from the money market funds. Is that, by the way, you know, people take the money market fund balances or AUMs are also at like all-time highs, probably. I mean,
There's a lot of money in the system.
But when a fund or a stablecoin issuer buys the treasuries that then go into the money market fund, don't they buy them and then give the cash they used to buy them to a bank?
To somebody else who is going to their bank account.
It's usually a bank, right? Because my understanding is for a dollar to exist, the only place the dollar can be held is in your pocket, like as physical cash, or in a safe deposit box, et cetera, at the Fed or in a Fed master account or tied to one or at a bank that has access to one or at the Treasury General account, basically, at the U.S. Treasury. Like there is no other place where – that's why like banks that don't have master accounts have a correspondent bank where they actually keep their cash at that does have a master account. So like there wouldn't be deposit flight out of the banking system because every stablecoin issuer, when they go to buy the treasury to put, when I come to Circle and I say I want USDC and I send them cash, they take the cash and buy a treasury with it.
Yeah.
And the person from whom they bought the treasury gets the cash and puts it in a bank account,
That's
right?
right.
So there's no deposit flight from like X the system. That's not a thing, right?
Well, first I would say that a genius chartered payment stablecoin institution is a bank. They
Yeah.
are a part of the system.
Well, and they're now under Genius. They would be, right? It's like an OCC license,
yeah.
or I think a state pathway to be a state bank, effectively.
Yeah, it's just this system.
Yeah.
But let me steel man myself. I do think the one thing we don't have today that we never had is we can't make payments with a money market fund, right? Like I use money market funds. If I want to pay my rent, I have to cash out a little bit of that security, wait a day or 3 if there's a weekend, and then transfer the money to my bank account and pay my landlord.
That's right.
There is a future state in which, with stablecoins, if they become widely adopted enough, and this is me arguing against myself now.
Yes.
The circular nature of I will just have a stablecoin that I hold to earn yield and save in dollars, and then when it comes time to pay rent, I will just send it to my landlord's wallet.
Yeah.
And my landlord will just sit on it until my landlord needs to
Buy groceries
or pay taxes, and then they'll just send it to the municipality who'll sit on it until they need to pay off their debt. That flow might reduce deposits in what today we understand as the banking system. This is very, very hypothetical.
But at the highest level, the cash that was used to create the stable is still sitting at a bank somewhere, right?
It's true in T-bills.
That's right. But and even then, it is in T-bills. But again, like to buy the T-bills, the issuer buys them with cash.
Yes.
I guess theoretically they could buy them directly from the Treasury, but my understanding is they mostly don't, right? They buy them from the big banks, basically.
Oh, yeah. Well, you can't buy direct. Only the primary dealers are allowed to do business with the Treasury.
Yeah, if you were, so they buy them from the primary dealers. Yeah. And so if anything, the deposit in your scenario is going to still end up at a primary dealer at the worst case scenario, which is a big bank, right? It's not going to. So is the community bank thing real, though, then? Like, would they, just because, like, in the scenario I'm describing, the deposit does eventually flow, but most likely to like a GSIB. Yeah. It's most likely not going to the First Bank of Nebraska. By the way, if that's a real bank, we apologize. Purely hypothetical.
Yes, I just made it
we don't know anything about it, but it seems plausible that it could be called that, right? Like it's most likely going back to the GSIB or the primary dealer's bank and not to like some random small regional bank.
Yes.
And then those people, if you're in Spokane or some random place.
Peoria. That's usually the place we're supposed to use.
Maybe you, as a local person, pay your rent from your stablecoin wallet to their stablecoin wallet, and now you don't need the First Bank of Main Street for payments.
So let's talk about community and regional banks. For those who don't know, the U.S. is exceptional for having thousands and thousands of small banks. And the cost and benefit of this gets debated. Small banks are more fragile. Small banks have a harder time keeping up with infrastructure and technology upgrades. However, small banks are more innovative. Small banks are far more likely to take a chance on a young person or up-and-coming small business owner who wants to borrow 20 grand than Bank of America.
Right.
Like Bank of America can't be bothered. It doesn't move the needle for them. Right. So this is an interesting debate. And then it falls into also the general debate about federalism in the U.S. Community banks are regulated at the state level. State regulators have always been more innovative, right? Shout out NYDFS, despite my annoyances with the BIT license.
Right.
They were the first major American regulator to say, yes, stablecoins are fine.
Yeah.
We just need rules about the reserves and bankruptcy remoteness, and great, go ahead and issue them. So that's the lay of the land. And what we keep hearing now, suspiciously from the big banks, is that stablecoins will really harm community banks.
Right.
So let's look at some stats. First of all, community banks already pay more interest than the too big to fail banks. Why? Because they're not too big to fail. Right. They don't get that taxpayer subsidy, and they are riskier. So if stablecoins pay yield, community banks are already in a better position to compete with them than a Bank of America or Citibank account. Second, the demographic of small bank customers skews older. Third, a lot of times the reason why somebody in a more rural part of America has an account with a small bank is because of a personal connection, right? It could be a family member or a friend who works there.
All three of those, the higher yield, the skewing older demographic, and their personal relationship, they make the deposit stickier.
Yeah.
Yeah. As opposed to the faceless GSIB.
Yes.
Yeah.
So when I think of a farmer in Iowa that has an account with a local ag bank, where the assistant manager is his brother-in-law,
Right.
and this is also the bank that gave him his first mortgage for his farm. And then do I think that's the person who's going to sign up for a digital wallet to switch to some weird thing called a stablecoin because it pays more interest?
And again, we're talking about maybe a percent or two more, not even that much.
Right.
Yeah.
Certainly as lower gap than if you're a large or a SME, a middle market business in an urban area that today banks with a GSIB because you have to rely on them for payments and other services, and they pay you nothing.
Right.
So I think ultimately, I think the payments use case for stablecoins are far more attractive than the yield use case. Right. If all you want to do is park your money somewhere, you have a money market fund, right? Or there are many banks that, like the Goldman Sachs's Marcus account, pays like 3-point-something%. If you just want to park your money there for the next 2 years, that's already taking money out of the deposits that create credit.
Right.
So I think you came up with this line that the big banks are using the community banks as human shields.
Yeah.
And the irony of that is that all of the largest banks in America are currently executing a expansion plan to take more deposits. So JP Morgan, Bank of America, they've explicitly stated, we want to grow our deposit base. This morning in the FT, there's an article of all the new branches that the Chases and BofAs of the world are opening in new markets. So let me ask you, Alex, who does Jamie Dimon think he's taking deposits from when he's doing this?
Yeah.
Right? So the real irony is that it's actually the big banks that are trying to kill the community banks by taking their deposits, which we also saw during post-SVB.
That's right.
Massive deposit flight, which has led to, there's an alternative proposal out there in Congress that has nothing to do with stablecoins, as far as I know, which is to significantly expand the FDIC insurance limit at community banks to prevent the kind of deposit flight that happened post-SVB. And the idea is we should make the big banks pay for it because ultimately they get a taxpayer subsidy that small banks don't.
Yeah.
Which I think is a very reasonable argument, which of course the big bank lobby is vehemently against. They're also trying to kill credit unions by getting rid of their making them pay taxes even though they're nonprofits. I'm not a big fan of the lobbying position of the largest banks, as you can tell, because I do think, and I don't use this word common, they operate from a place of privilege. And what they're doing in the stablecoin debate is really abusing that position.
That's right. I think that's right. And it is, I think, very clearly more about protecting their profits and preventing competition. I can't, the point you're making about the big banks expanding to Main Street at an extremely expanding rate is so ironic and disingenuous, right? They say stablecoins will kill community banks. That's our job.
The CEO of PNC Bank, which is like a tier below the GSIB.
Yeah, but it's a big one.
It's a big one.
Yeah.
Super regional bank. Was in another podcast not that long ago saying that there's apparently some percentage number that's understood in banking that if you get branch concentration, you didn't get deposits.
Yeah.
For some.
So what, like
social.
if you're one of two in a zip code or something like that?
Some number, yeah. And I'm like, well, yeah, again, he knows it, Jamie Dimon knows it, Brian Moynihan of Bank of America, they all know it. It's a banking industry thing. Well, who do they think, where are they going, where they're easily going to become a significant percentage of branches, right? Again, it's not a Wells Fargo is a West Coast bank. It's not them taking market share in New York City by opening more branches than Chase. It's them going in other parts of America where it's really the community banks and the regional banks that have the bulk of the deposits and opening a bunch of branches because they can afford to.
Yeah. They can operate at a loss for a while just to open them and capture share.
That too.
Yeah, plant their flag.
Yeah.
Yeah. It's really something, though.
It's something.
But meanwhile, if we let a person, while they're holding a stable coin, capture just a couple percent,
God forbid.
God forbid, and it's apocalyptic.
And the point you made when we were talking before we started recording is that ultimately, whatever happens with Genius and Clarity will apply to U.S. issued stablecoins that are held by Americans. They do not apply to foreign issued stablecoins held by foreigners, even if they're dollars. So imagine a scenario under which Americans hold a dollar stablecoin, they get no interest. Foreigners hold a dollar stablecoin, they get 2%, 3%. Meanwhile, where does the yield come from? It comes from treasury bonds. Who pays the interest on treasury bonds? Americans. So Wall Street is now arguing for a position where a citizen in Hong Kong who holds a dollar can get the interest from middle-class Americans, but middle-class Americans can't get the same interest. This is a very unpatriotic position for them to take.
It is. It's truly shocking. I don't know how close you've been following. Do you think we get a compromise here? Because right now, I think the state of this clarity negotiation, it's very clear from the meetings they've had twice now at the White House, literally between the banks and crypto representatives and trades, that it's this yield issue. And the banks put out a principle. They finally did some homework and the White House, Patrick Witt, shout out to Patrick Witt for, pushing this ball forward diligently and working hard on this. After the first one, I guess it was sort of a meet and greet. And then he said, listen, literally come back with actual concrete substance. And of course, they didn't come back with new language for the bill, but they came back with a one-page set of principles which said ban all stablecoin yield.
Not just that.
And that's clearly unpalatable to the crypto position.
Not just to the crypto position. Ordinarily, I would have guessed, my gut would have been, I don't know nearly as much as you do about how things work in Washington, but my gut would have been that because the administration wants a bill and the industry wants a bill, and you say, well, we get, of the 8 things we would love to have, we're getting 6, and that's pretty good. That the stablecoin yield thing would just get sort of thrown under the bus. Right. And to be clear, I don't have a dog in the fight. I don't have any financial interest in any of this. I don't work for anybody. It's just like from the principles, like when people make bad faith arguments using demonstrably wrong data, it upsets me. But the funny thing about that principles document that the banks put out, it is so unbelievably reactionary that if that goes into the law, it's going to cause a lot of other problems. Because one of the things that they say is no one will ever be able to pay rewards for using a stablecoin in a transaction. So does that mean if Delta Airlines wants to give me airline miles and I pay in a stablecoin, it's illegal? Right. Like you open up a whole can of worms that basically negates the reward system of credit cards. Yeah. So they're being, I don't know if this is their like place of negotiation or they're just being very arrogant about it. Yeah. So I don't know what will happen. But my fear is that if the TradFi world gets what it wants on this issue, it will come for things like DeFi and permissionless systems next.
I see. That's interesting because the state of the negotiation is that it seems like the other issues, there were compromises in the Senate banking ANS amendment in the nature of a substitute, which is their latest draft, right, that was from early mid-January. There were compromises in there on DeFi front ends, what is decentralized enough, et cetera. Dev protections for open source developers were in there, explicitly clarifying that money transmission laws don't apply to non-custodial services is in there. Some great stuff, and it seemed like those were settled. But even in this debate, and this isn't quite what you're saying, I think, but I'll get to your point about it, but even in the debate, it's not actually clear if they are settled because the whole debate has now been diverted on yield. Yeah. Let's say tomorrow we get a big, giant handshake, blue ribbon deal on yield that everyone agrees is good, and now it's off the table as an issue. It's possible those other issues could be raised in this clarity debate. We didn't quite get to that point, but I think your point is even bigger, which is let's say, okay, they're settled in the law and it passes and yield is given away or compromised on to get that passed. You're saying like what says they don't come back during the farm bill next year and try to add a DeFi provision to retrade again.
And for evidence of that, I would submit the fact that we thought Genius settled the stablecoin issue. And here we have a market structure bill, which generally have nothing to do with yield.
No.
But they raised it. So yeah, It's always possible they come back down the line. And my fear, because I believe in so much in the value of permissionless systems, but they do they're a very major competitive threat for Wall Street, is that they will continue to innovate roundabout ways of trying to kill that, right? So maybe in some future unrelated bill, they sneak in somewhere in there that Bitcoin miners and Ethereum validators have to do KYC.
This is what they had too in the what was it called? The inflation. Biden's bill in that summer.
The oddly named
the Inflation Reduction Act.
The highly inflationary Inflation Reduction Act. Yeah.
And they slipped in this stuff about the broker rule, the
Right.
DeFi broker rule into that. And we briefly thought maybe we could get it out. And there were some allies in the Senate who gave speeches and tried to get it out. But eventually, like this very restrictive, terrible rule, which has been now revoked by law also for DeFi, was just added into some random bill. And it was must-pass legislation, too. So everyone was like, guys, we got to save America. We can't be held up with this arcane, like, tax question for DeFi. So you have to swallow it.
Right.
That risk is always there.
Yeah, and if I may end with a warning, because I believe you have a large TradFi audience for this podcast. If I were advising the banks, I would tell them to be very careful here, because they keep going back to this argument that Wall Street should be thought of as a utility, that it provides this fundamentally needed service, that's why they deserve protection from competition. The problem with that argument is that it opens up a whole can of worms on everything else that Wall Street does. And what you end up with is people like me saying, well, if you are a utility, the thing with utilities is that they're highly regulated, including what prices they charge and how much money they make. So if you're a utility, I think we should have a cap in credit card swipe fees in America, like many other countries have implemented. If you're a utility, I think the big banks should be forced to pay for infinite FDIC insurance at community banks, right? And even the idea of a windfall tax on net interest income, right? Utilities, the power utility here in New York can arbitrarily raise the price. They have to go to the regulator, say, here are my costs, here's the market, here's how much I want to raise. And then the regulator says, well, what's your profit margin? Because it can't be too big. Why? You're a utility.
That's right. Very interesting. And it sounds like, too, on your point on the what I'm hearing is that perhaps defending and winning the fight on yield one of the reasons that might be important is because it's a beachhead for the longer term battle. And if we lose the yield issue to the banks, like they'll be emboldened and come back to take away our DeFi issue or our, other dev protections issue or et cetera.
Exactly.
So it's kind of like you got to fight the battle now, because like winning it now will help you win it later. Losing it now will risk losing it later.
Yeah, or if we're going to lose it, I want to lose it on genuine grounds. I want somebody in Congress to say, we just want to make sure that Wall Street can keep operating the way it has.
Yeah.
Don't give me this song and dance about like small business lending. The simplest way small businesses get a loan is by having a credit card that charges them 20% interest.
That's right, the vast majority. This has been fascinating, Omid. Before we wrap, I want to ask you about Columbia.
Yeah.
You've been teaching a core blockchain class there at Columbia Business School for years now. You've graciously had me there to speak a few times now. I think 3 times, maybe.
You have historically been one of the more popular speakers.
But you have
I've
great
had in my
speakers. You had Rob Haddock there. I
was
think
great.
shortly after I was there this year.
That's right.
You've had people from government come. You've had regulators. Our friend Nick Carter has spoken there multiple. It's a great class, by the way. Great.
Thank you.
How has the interest in blockchain and crypto evolved over the time? And I should clarify, too, this is a business school executive MBA program class. So these are working both
MBA
and core MBA. But these are business school kids.
Yes.
They're not 18-year-old college freshmen.
No, and they're
Just
not
for the
computer
demographic.
scientists and
That's
cryptographers.
Right.
Yeah.
So, how has it evolved, their interest, and what is the state of their interest today? Are the youth going to be all right?
Yes, interest is actually at an all-time high, and people keep asking me, basically not impacted by price action over the last 6 months. Price action is actually great. Crypto prices were crashing 2 weeks ago during class. I was actually put up the chart of the perps trading in real time. It's like, let's look at what's happening on Hyperliquid and we can talk about it.
Yeah.
The students increasingly just see this technology or this industry as a part of their futures, which is why their interest, as measured by things like how many people sign up for my class, the wait lists, et cetera, demands to audit it, it's literally been up only.
Yeah.
Um,
And that room is packed. You didn't have any when I was there. In December maybe. There's no room. Like every seat is filled.
Yeah, with 75 students
Yes.
and lots of people begging to get in because they didn't make the cut,
Yeah.
and me having to say no because there's no room.
Yeah.
And I have every student submit a 1-paragraph answer before the start of each semester saying why they want to take the class. And the evolution of that has been super interesting because 6.5 years ago when I started teaching, some curiosity, tons of skepticism. Like I would literally have people say, like, I think the whole thing is a scam, but I figured I should learn more.
Yeah. Reasonable position, by the way, if you're willing to learn more, at least.
My favorite kind of student
Yeah.
is the skeptic.
Yeah.
If you're skeptical of something and you're willing to take a semester-long class, and by the way, my class is hard,
Yeah.
and there's a ton of assignments, a very tough exam, etc. Now, I don't get any of that. I would say 80% of the students say that they want to take this class because whatever future they envision for themselves, it's a business school, so we're talking about banking, consulting, tech. They just think blockchain, crypto, tokenization is going to be a part of it. And also very exciting, a minority, but like 10, 20% of every class now is students who say, I want to work in this. I believe in it. I'm excited about DeFi, about stablecoins, about NFTs, all of the perennial ideas, and I want to learn more about it. And I would say not investment advice, not a price prediction, but to me, the most bullish thing about crypto in general is getting to experience firsthand how the utility of it is just becoming more and more given to a wider group of students.
I agree. I think adoption and knowledge of crypto and stables and Bitcoin and DeFi is one of the clearest signals, right? And you can see it in so many ways. Omid, this has been fantastic. Thank you so much, my friend, for coming back to Galaxy Brains.
My favorite podcast to be on. Thank you for having me.
That's it for this week's episode of Galaxy Brains. Thank you to our guest and friend Omid Malekan from Columbia Business School and our friend Beimnet Abebe from Galaxy Trading. Everyone have a safe and happy weekend, and we will see you next week. Thank you for listening to Galaxy Brains, the weekly podcast from Galaxy Research. I'm Alex Thorn, head of firm-wide research at Galaxy. Follow me on X at Intangible Coins. Follow Galaxy Research on X at GLXY Research. Read our written reports at galaxy.com/research. And don't forget, if you like Galaxy Brains, to like and subscribe on your favorite podcast platforms like YouTube, Spotify, Apple Podcasts, and more. We'll see you next time.